Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand Forex Gold and S&P Fundamental and Technical Analysis for the week ahead, starting the 10th of August. And hope you all had a great trading week. And getting into the week ahead. So next week, investors will remain focused on trade tensions, watching for any progress towards a US-China agreement before the 12th of August deadline, after which tariffs exceeding 100% could be imposed. Geopolitical developments will also be in the spotlight as President Trump and Putin are expected to meet soon to find a solution for the conflict in Ukraine. In the US, key releases include CPI and PPI, retail sales, industrial production, and the preliminary reading of the University of Michigan's consumer sentiment. Globally, attention will turn to China's industrial production, retail sales, and new yuan loans. Eurozone GDP, Germany's ZEW economic sentiment, Japan's preliminary Q2 GDP, and the busy UK docket with GDP, labour market, industrial production, and trade figures. The RBA will also be announcing its monetary policy decisions. So, lots going on in the market this week, as shown by Trading Economics. So you can go to tradingeconomics.com to get a bit more information about that. Anyways, looking at risk sentiment. So risk sentiment is always important to look at where really money is flowing into and out of. So first of all, starting on the top left-hand side in the VIX, at the moment, we did have last week, due to the non-farm payroll numbers, the jobs numbers, we had a lot of volatility, massive surprise in the market. But this week, volatility has really kind of dropped off. Anything above 20 is seen as a bit more risk off, or at least risk neutral. Anything above 20 is seen as more risk off. Now, we are in the summer, so during the summer months, August, traders really aren't at their desks, and so volatility is expected to really be more on the lower side. But of course, any risk event, any surprises in the market, and I guess the algorithms will pick up in the volatility. But for now, you would assume that the investors are more concerned with probably more risk on yield return, and but the downside to that is that volatility is on the lower side. Looking at the risk on more the kind of confirmation sentiment, we did have a bit of a pullback on the S&P, but as you can see, we're approaching these new highs. And so from a monthly perspective, you can see we're, again, price action, we're looking at approaching new highs. If you look at the trend over the last 3 months, you'll probably be able to see that the S&P has really been in this upward trend. So again, you can see really risk on sentiment. Although we've had trade deals or risk of trade deals falling apart, I think the market has kind of expected really deals to be done. Gold is heading higher, reaching that 3,400 mark. I think it's more of a function of dollar weakness than maybe risk off sentiment. Of course, there are possibilities that deals don't get done, but I think those would be more localized. So, for example, if the Switzerland don't do a deal, or a deal doesn't get over the line, or some other countries, then possibly those will be more localized. I think the one that would affect everyone globally would be, as we've kind of read, China. So if China doesn't get their deals done, and maybe some sort of 100% tariffs get imposed, then of course that will end up hurting the global economy. But I think there is obviously a risk of that happening. There's always going to be gold bugs that are going to be looking to buy gold anyway. But overall, you would think that the VIX being down, stock market being up, gold being up, again, it's probably more of a more dollar selling than really gold buying. But doesn't mean that there isn't any risks to that. Of course, there is the risk of inflation as well, coming back to the market, as tariffs do have an inflationary effect, and the market could be looking to get involved in buying to hedge against inflation before inflation rears its ugly head, if that is the case. And we've also got 2-year Treasury yields, the US 2-year, and again last week we did see a massive sell-off as the market was the bond market was pricing in, I guess, um, uh, rate cuts. And so, with the bond yields, they typically do lead, interest rates. And so they're hypersensitive to inflation and GDP. And so, if you ever want confirmation of whether the move is affecting, Forex, you can look at the stock market the bond market to see that taking shape. So you can see obviously that sell off happened, and at the same time you had the volatility index moving to the upside, as well as the dollar selling off last week Friday. So that kind of confirms that rates are likely to kind of fall in at least for now. So at the moment, risk sentiment, we can kind of derive that risk is probably a little bit more on than off. It's a scale, it's not binary, it's not on or off. There's varying degrees, but also as well, gold does look like a potential buy as well, based on dollar weakness, as well as the potential for, of course, any kind of risk events to turn out a bit ugly. So, looking at the summary report, and really starting off not on the British pound but on the US dollar. And so, the US dollar future central bank policy. At the moment, the market is pricing in around 59 basis points of rate cuts, and there's a 93% probability of a rate cut at the upcoming meeting or there or thereabouts. So the summary of the analysis is that the weak labor data, increasing signs of tariff-driven inflation, and mounting expectations of rate cuts are weighing on the dollar. The nomination of a Fed member further supports this outlook. Despite resilient earnings, macro risks point to a depreciating dollar trajectory. The Fed is likely to cut rates in September, with at least two more cuts expected by January 2026. While inflation risks from tariffs remain, the Fed appears more concerned with labor market weakness and downside economic risks. Tariff impact: the gradual CPI impact could complicate the Fed's path if inflation remains sticky. However, current guidance and market expectations favor a dovish pivot in policy despite this risk. So for me, I have a sell bias. Again, this summary report really is for members only, but I will share like the major pairs with you guys on YouTube. But yeah, the dollar is a sell ever since last week's really disappointing news. So looking at the dollar overall, and this is the equally weighted dollar index, meaning that the dollar is equally weighted against the euro, the pound, the yen, the CAD, Australian dollar, New Zealand dollar, and the Swiss franc. Zooming out a bit, you can kind of see dollar weakness ever since the non-farm payrolls last week Friday on the 1st of August. So ultimately nothing's really changed that, although CPI on Tuesday could limit the downside for dollar weakness, because if CPI comes in and it's seen as being sticky or comes in higher than forecasted, then of course that could complicate the central bank's thinking as to whether they are going to, hike rates, or sorry, cut rates aggressively, because they're in a kind of stagflationary environment with, maybe the contracting economy, and obviously inflation rising. Now, that scenario is still usually typically bearish for a currency, but the market may use it as as a narrative in the short term to kind of make the dollar appreciate, so they can kind of sell a bit later. So if CPI is above forecast and seen as problematic for the Federal Reserve, and you see a move to the upside, personally, I'm looking to still look for short trades on the US dollar, either around here or here now, and not necessarily uh, trading this because it's not really a tradable. The index isn't tradable, right? Brokers don't really have this. But what you want is, if you're looking for short trades on the dollar overall, you really need to know that the dollar is appreciating against all the currencies, all the other currencies in an equal fashion, so that when you're looking to short and it's seen as expensive, then across the board, that's when you want to look for short trades, right? In the same way that if you're looking to buy the dollar, then you want the dollar actually to be cheaper against all the currencies. Right now, again, what determines cheap and expensive, or discounts and premium prices, is really the fundamental side of things, right? That's what derives value. So at the moment, rate cuts, the central bank are actively looking to devalue their currency, or at least that's what the market thinks. And so the market is getting ahead of that. So any pullbacks, as long as the fundamentals don't change, or they're still seen as cutting in or pricing in 2 to 3 cuts, then these will be great, I think, shorting opportunities. And then you just go to your currency pair that you want to short the dollar on, and as long as you've got that on your side, and also as well, you're going to have a buy on the currency that you really want to be a buyer of. So if you want to be a buyer of a currency, you want to see it as cheap. One's expensive, one's cheap, and then you look for your trade. So that's really the dollar. Again, sell bias. Looking at the euro. So the euro, I have a buy bias continue. um, uh, Usually the dollar and the euro move inversely. So if the dollar's a sell, then the euro will kind of benefit from that in terms of appreciation. In terms of the central bank policy, the euro at the moment, the market is pricing in around 13 basis points worth of cuts by the end of the year, and 88% probability of a rate hold at the upcoming meeting. So there's definitely a divergence there between the dollar and the euro. And summary really is that inflation is at 2%, but even across the eurozone, the inflation gap across the bloc widened to 5.5 percentage points in July, well above the historical average of 3.6 percentage points, highlighting how difficult it is for the ECB to craft a one-size-fits-all monetary stance. The ECB kept the deposit rate at 2% after 8 cuts in a year. Lagarde said the ECB is in a good place with inflation stabilizing, but refused to guide on whether rate cuts will resume in September. Markets have reduced expectations for further cuts this year. The ECB sees 2% inflation as progress, but not a signal to accelerate easing. Ongoing inflation divergence, services inflation, and Lagarde's wait and see tone suggests the easing cycle is likely on pause, keeping the euro relatively supported in the near term. Central bank decisions will hinge on September inflation. September inflation data and updated staff forecasts. So, again, I think every central bank is obviously data dependent, but for now, the euro and the ECB seem to be satisfied with the value of the euro and inflation. So they are looking to hold rates, right? They're not looking to actively devalue or try to appreciate their currency. So when it comes to the euro index, and again, the euro index is just the euro strength equally measured, equally weighted against the dollar, the pound, the yen, the CAD, the Australian dollar, the Swiss franc, and the New Zealand dollar. You can see pretty much it's appreciating, right? So I'm waiting for a pullback into a nice zone. Hopefully, can get some cheap readings on that, some discounted readings on that, somewhere around this area here before looking for a buy, right? A lot of traders would just buy the euro at highs, right? And then wonder why prices aren't going higher. Now they could go higher, but investors typically look for value, right? Successful ones anyways. So ultimately, if this was an expensive area, right, proven to be expensive, and then prices sold off, why would you buy the euro at an expensive area, right? You want to at least buy it at least some sort of fair value, which is around this area here. So between an expensive area and a discount area is fair value. So that's where I'm looking to buy the euro on a pullback. the Japanese yen. Japanese yen, my overall really bias is still more short term, although I do recognize that there are reasons to buy the Japanese yen. But until really the Bank of Japan get a bit more hawkish and start to have a hawkish tone, I'm going to probably remain bearish on the, or lean more bearish on the Japanese yen. So it says here a summary board member suggested that the central bank could exit its wait and see stance and hike rates by year end if US tariffs don't significantly damage the Japanese or global economy. The impact of tariffs will take 2 to 3 months to assess, while inflation has remained at or above 2% for over 3 years. Surprising. The Bank of Japan officials disagree on whether this is sustainable. Some see underlying inflation around 2%, but others warn of downside risks and question its durability. One board member emphasized the need to prioritize upside price risks, noting that inflation is beginning to affect household sentiment and medium to long term inflation expectations are rising. As expected, the Bank of Japan left its benchmark rate unchanged but raised its inflation forecast and softened its tone on global trade uncertainty. Despite internal hawkish tones, Governor Ueda downplayed expectations of an imminent rate hike, signaling caution and patience at his press conference after the July 31st decision. So, again, a dovish Ueda means. The upside, I think, for the Japanese yen is likely capped. The BOJ is not ready to hike yet, but the internal tone has shifted towards preparing for it, possibly in late 2025. If inflation holds and the US trade tensions don't escalate, this could lead to the first rate hike since March. Market participants will now watch inflation data and global trade developments closely for clues on timing. So, again, there are reasons to buy the yen or sell the yen, but I think for now, I'm leaning towards more of a sell on pullbacks. I did get in on a yen sell this week. It was the CAD yen, which actually worked out, and it was a profitable trade. So I was saying last week that we could obviously get a bit of a sell. Of course, you want to sell at highs, buy at lows. So I did think that if you check last week's analysis, I was saying that although the yen is appreciating, I think it's more of a function of the US data rather than Japanese data, right? And pretty much that's what kind of worked out this week, thankfully. We got pretty much a few days, pretty much most of the week was a sell-off. Now that doesn't mean that prices won't necessarily won't be a buy down here. Prices can always pull back, or even a buy right now, right? But for me, I think any pullbacks into a level of supply or a level of resistance should be seen, or I'm seeing them as selling opportunities until the Bank of Japan start to strike more of a hawkish tone. Looking at the British pound, so this week the Monetary Policy Committee, Bank of England, cut rates by 25 basis points to 4% in a 5-4 split, requiring a second round of voting, a first in the committee's 28-year history. So that was a shocker. Two top officials, Chief Economist Pill and Deputy Governor Lombardelli, dissented. Inflation is now projected to peak at 4% in September, double the 2% target and higher than May's 3.7% forecast. Rising food prices and wage costs from tax and minimum wage hikes are adding to persistent inflationary pressures. Markets reprice easing path, and so despite Bailey's insistence that rates are on a downward path, he admitted that there is now genuine uncertainty about the next move. Odds of a November cut fell below 50%, and the pound rallied 0.5% against the US dollar. A Bank of England business survey shows stagnant growth expectations, sticky wage growth at 3.6%, and higher planned price increases. Employers also expect weaker employment growth, with 185,000 jobs lost since recent tax hikes. The Bank of England is caught between softening growth and sticky inflation, and that is really what is known as stagflation. So again, a bit on the negative side in over the medium to long term, and I'll get into that in a sec. But future cuts depend heavily on clear disinflation signals, especially from food prices and wages. November remains a possible cut date, but is no longer a baseline expectation. So ultimately, it was a hawkish cut from the Bank of England, um, due to inflation being coming in, inflation forecasts anyway, being projected to be a lot higher. Now, the market pre uh, uh, Bank of England announcement, I think was at around about 48, 47% in terms of the central bank policies, but now it's down to 18 basis points. And they're looking at obviously more hold. So that seems obviously a lot more hawkish. Obviously, the Monetary Policy Committee was a split vote. That was definitely hawkish. So they're not necessarily leaning, to either cut or hike, aggressively. And so all that in the short term means that the pound is obviously a bit of a buy. Now, I think that the pound is going to be is looking to be a sell on stagflation. Stagflation is normally a negative for a currency, and so I think in the short term this could end up moving actually a bit higher, right? Because really, the Bank of England cut was on Thursday. We do have Friday. To try to short now is going to be quite brave. Doesn't mean that it won't, move to the downside. But I have a sneaky suspicion that even if it starts to sell off, that prices, may drift a little bit higher before coming down. So, it's just a feeling. Of course, people say, trade what you see, but I think there is a case really for kind of like a feeling. I mean, you get a feel for the market. Been doing this for quite a while, so not to say that you can't get into a trade and start to short the pound now. If you are, then personally, I would only enter a very small position, much smaller than normal, just to see if the trade works out. But ultimately, I would think that we could drift a bit higher before going lower. And one of the main catalysts for that is the September budget, right? So in the UK, the Chancellor is going to, Rachel Reeves from Accounts is going to release the budget, and I think the policies and the budget is really going to show and going to hurt the economy. So I think that inflation is going to be probably likely to be sticky, but um, the economy I don't think is going to do very well, and in fact I do feel that the bond market is going to sell off um, uh, quite drastically. So let's see what happens. But ultimately, you can look for either shorts now on the pound. If prices, if you don't enter and prices, go without you, then you haven't lost anything, right? It's just still, it's still, zero. If prices, if you try to get involved in here now and you lose the trade, prices go against you, then at least it's only a small trade that you've lost if you enter a small position. I'm gonna wait for prices to probably move a bit higher. Um, or maybe enter into a really small position on a pair that I was talking to the group about. But yeah, I'm still kind of on the fence about it. I'm kind of umming and ahhing about it. But let's see. The pound, though, for me, the higher it goes, the more of a sell it becomes. And so, looking overall then at the pairs, if I'm short dollars, right, and I'm buying the euro, I am leaning short on the yen, and I'm leaning short on the pound. It's then easier to kind of look at what pairs really to select in terms of the majors. And so buying the euro dollar, right? So just waiting for a pullback on the euro dollar. So a move to the downside. If we're looking at this over the month and looking at monthly highs, monthly lows, really, yeah, probably a buying now would be, buying at highs again. I think a pullback down to the 115.60s, 115.40s is going to be like the earliest that I would look for a buy. Down here would be even better. But I don't think it's going to get down there anytime soon. So a decent pullback of what would that be from here to here? That would be about 160, 170 pips is a decent pullback. So yeah, euro buy, dollar sell. Overall, we've got the dollar yen. Now again, if both pairs are really kind of on the sell side, I'm not looking for really a buy or a sell to trade this. From a fundamental perspective, I'm looking for at least one currency to be a buy and one currency to be a sell. So for me, this is not really on my list of pairs to trade. But if you're just looking for this from a technical perspective, then you could look for buys probably right now, or if you get a little bit of a pullback and you think the dollar is gonna, kind of bounce back, then it would probably do it against the yen. But from, if you're looking for maybe some yen sells, then you would look for prices to kind of move back up to this supply zone. And again, looking at this from a monthly perspective, yeah, you've got that unfair auction that needs to be completed. So technically, this looks really nice for actually a decent buy around here, so that it completes that auction. But yeah, this level here also looks good for a stop hunt. So either way, technically it looks nice, but I'm not touching it because it doesn't line up with my fundamental bias. The British pound. So the British pound rallied, and again, short term, I think, with the hawkish cut, we probably have a ways to go. We could see some more upside potential, likely to see some more upside potential against, especially against the dollar. Again, not really a pair that I would trade unless prices kind of pulled back to here, and the pound was seen as a bit more of a fundamental buy, no stagflation fears. But for now, again, not really a pair that I'm looking to trade. I think I'll just kind of skip this for now. But technically, looking at this from a monthly perspective, again, I would say, depending on, of course, your strategy, my strategy always involves a decent pullback. Pullback to here would be actually quite nice technically, but again, from a fundamental perspective, not really my cup of tea. Although I recognise that the pound is definitely on the buy side against the US dollar. It's in a better position. Euro, pound. So the euro pound pulling back, and now I actually do like this. Although again, as I said, I think the pound is going to be a tough sell at the moment, with the momentum going for a hawkish hold, right? But I do believe that somewhere around here should be a decent opportunity to look for a buy. So I think the euro at the moment is still king, and so any pullbacks, I think, are nice buying opportunities on the euro pound. Looking at this over the last month, again, we've got these monthly lows around here. So monthly lows can act as a nice, support, nice demand, because ultimately, you've had a massive move to the upside, proof that the institutions are buying here. So if they bought around here, the only thing I would kind of just be mindful of is the fact that this area could be stop hunted. It could go a bit lower, right? So because the more times an area is touched, is the least likely it is to be a bargain, right? Because if it was a bargain here and it was a bargain here, by the time retail traders look to buy, the institutions want probably a cheaper price, so they might look for something slightly cheaper, maybe around the 85 or 86 round number before pushing prices a bit higher. Looking at the euro yen, and I would say this would be a buy. So of course last week I was saying this, and look at what happened. It bounced off of there. Euro being a buy, nice trade to the upside. Didn't get involved in this, but I did get involved in the CAD yen, which I'll talk about on the trade updates. And so again, looking for any kind of buy trades, really I would say back down into this area here before looking at going long, unless of course the Bank of Japan start to turn very hawkish then. But for now, I think the euro should be continue to be the buy. And again, the pound yen benefiting really from short-term pound sentiment, a hawkish cut. So yeah, I mean, again, if I was looking to trade this, prices, you really kind of would need to wait for at least a decent pullback, or if prices make higher highs like this, then you would need for pull back into a demand zone before looking at going long. So for now, again, not really a pair that I'm interested in. Although again, I recognize that from a short-term perspective, the pound should be probably a bit more of a buy than the yen. Looking at the metals, and the metals again are more of a buy based on dollar weakness and the potential really to for gold to be the hedge against inflation. If you start to see in inflation start to rise and become an issue, then of course gold and silver would be your buys, right? So silver again waiting for a pullback, um, and that'd be decent for a buy trade both on gold and silver. Whether you get that pullback or not is another question. So looking at the indices again, we looked at it a bit earlier. The S&P rallying, maybe expecting um, rate hikes. Been saying this for sorry, rate cuts, I should say. Um, the stock market typically does rally during a rate cutting cycle. So any pullbacks, I think, should be decent buying opportunities. I said last week that this area was likely to be a potential reversal. Personally, I was waiting for a bigger discount. I didn't think maybe that 3% was big enough. I wanted to get involved maybe down at the 7-8%. I thought that would have been a nicer discount. May not get there, of course, but we could get there. Just got to be patient if you are looking for that longer term pullback to the downside. But if you did trade this, then looking at this on the monthly time frame, again, the monthly lows, right? Monthly lows there, monthly lows was bought up around the 6220. So yeah, but if you are looking for a sell, technically it is nice for a sell, selling at highs that was seen as expensive. This is a bit of a CPR zone as well. A lot of traders would have been caught at this high, breakout traders, retracement traders. So I think this area is decent for a sell technically. Actually, that really should be supply, not demand. But ultimately, my bias is more to the upside with rate cuts on the horizon and a weaker dollar. So looking at the new trades, so the only trade I entered this week was the CAD yen. So looking at this from an hourly perspective, this was a daily demand zone. I was going over this in the Discord group, made a video about it as I entered into the trade. The guys know the strategy anyway, and so my entry was at 9 o'clock, so pretty much right here. Entered into a market order there. Was waiting for a pullback to 50% as well as the 95% now. Sometimes it happens, sometimes it doesn't. It didn't happen this time. Prices literally just kept going, pulled back a little bit, but then eventually reached the one-to-one target when entering into one position. Now, I did take off 80% at one-to-one, and in anticipation of there was Canadian dollar data. The data actually came out, the unemployment data came out better than expected, but the employment data wasn't great. So as prices, as I saw the data, I did take the remaining 20% and take profit. So overall, it was probably just slightly less than a one-to-one, but overall a profitable trade, right? So that's it. So now I'm flat on that. There's no trades in that, and just waiting for, and I'm flat on everything. So no new trades. I'm not currently in any trades. Last week, I took profit on the dollar Swiss, so that was a profitable trade as well. So doing pretty well. You can always follow along on YouTube, go back through my videos, see what I've been trading and what I've won and lost, and so on and so forth. But yeah, let's see what next week brings. Hope you enjoyed the analysis, found it useful, got a bit of tidbits here and there, and I hope you all have a great trading week. Take care, all the best.